The price rate of change indicator, or ROC as is commonly abbreviated, is one of the most important stock indicators for screening stocks. It's actually really simple. It's basically just the percentage change that a stock has had in its price over a given period of time. So, for example, if a stock has gone up by 14% over the last 20 days, then the rate of change is 14 or 14%. So you can change the time period depending on the screener that you're using. A common time period is 14 days, but it could be anything, and I'll show you why that can be important. So the rate of change is not just important for looking at one stock by itself, but it's also very useful to compare a stock to another stock. Or in many cases, you'd want to compare to a benchmark such as the S&P 500 or the SPY ETF. Here's a chart showing the Apple stock, and then it also shows the SPY in orange, and then the QQQ, which is the NASDAQ, in blue. So as we can see from the period where this chart starts over here, obviously the rate of change of the Apple stock is higher than both of these for this time period. So let's say you're using a stock screener, you may want to look for stocks that are currently beating the market or beating the S&P 500 average. So this would be a good example of a stock that is. The important thing to keep in mind, however, when you're using the rate of change for stock screening is you have to think about the time period that you're looking to screen for. So for example, if you're doing very short-term trading, it would seem that trading the Apple stock would be doing better than the S&P 500. But you shouldn't make the assumption that it's going to do better over the long term. So let's see what happens if we zoom out a bit and look at a longer time period. So as we go to a longer time period, we see that the rate of change is actually better for the S&P 500 and the NASDAQ indexes. Now, calculating the rate of change would depend on exactly where you're starting from. For example, you could start from this point and calculate it to here. So in that case, it seems the rate of change of the Apple stock would probably beat the other two from this exact point. But you can see if you go further back, the rate of change of the indexes actually beats the Apple stock. So it's important to consider the time period that you're going to look at holding the stock for when you're considering the rate of change. If a stock's been going up really quickly compared to the indexes, the rate of change is going to be higher, but you're going to have to watch that stock closely. It may not continue indefinitely to be higher. So if you're more of a buy and hold investor or a swing trader, you're going to want to look at the rate of change over a longer time period, or at least factor that into your consideration. A lot of stock screening tools have a set time period for the rate of change, and you can't customize it. So it can be misleading when you use these because you're only looking at one period, at usually like 14 days. So if you're really looking to use the rate of change indicator in a more complex, in-depth way, you need to make sure you're using a tool where you can adjust the time period, because it can be deceiving otherwise.